Hi, Sam Spernat here from The Informer. Today on Property Matters, we're actually going to go a little bit of a different path and have a bit of a roundtable discussion about building your team. What's that? Well, when you're starting to look and think about buying a property, it's always good to create a team, having your accountant and your financial planner working with your advisor. So I'm joined today by Peter Meakin and Justin Porch from OHM. Peter's the Director of Financial Planning and Justin's the Director of Accounting. Thanks for joining me, guys.
Thanks, Sam.
Cheers, Sam.
I think one of the things that people tend to gloss over when looking at property is actually understanding what are they doing, is it the right asset for them, is it the right thing to even do? And Justin, you and I have talked at length about negative gearing and depreciation and all those really fun, exciting topics that tend to make people glaze over a bit. If you could just give us a bit of a rundown of what they actually are and what they mean.
Yeah, so negative gearing is basically when you're making a loss on your property for tax purposes, and that loss you can deduct off your other income. So it creates a tax benefit, and people quite like that often when they're investing, because it's not even associated with a cash flow loss, because you can depreciate the property, which doesn't deplete any cash reserves, and you're still getting a cash benefit from the tax you're saving on the investment. So one of the issues with that people often don't know about is how that affects the capital gain at the end. So if you sell the property, generally it's the accountant that gives you the bad news at the end to say that you've made a capital gain when you thought you didn't. You said, I bought a property for 800 grand, sold it in 10 years for 800 grand. Why am I paying tax? And it could be because you've depreciated it by 100,000 over that time, and now that has been taken off the cost base. So now your cost base is 700,000, you made 100 grand gain, which gets taxed at your marginal rate. But you do get a 50% tax CGT discount.
As long as you've owned it for over 12 months.
Yeah, exactly.
Yeah, and I think that's something people don't realise, that the government kind of robs Peter to pay Paul with that one, and it's amazing how many people don't quite understand that. And I was an accountant in the deep dark days, but we won't mention the war. And Peter, I think one thing that people don't quite grasp is making sure they're buying the right asset for their portfolio and their asset mix. And they might own shares and some managed funds, but then they've got to also buy a property that suits what they've already got.
Yeah, correct. So the foundational cornerstone for us is what's the right structure, strategy, and how we're going to review this. So we could buy a property that's $500,000, whether it be an apartment here in Melbourne, a house in Brisbane, it could be anything, anywhere, but what's the intrinsic purpose of that? How is that going to complement the other things that we already have existing in our portfolio? How is that going to reduce the risk to us for when systemic things happen, whether it's global pandemics, when the roof blows off, I lose my job at Telstra? How can we protect you to be able to give you the duration in that asset to allow it to do what we want it to do, which is to create wealth for you and your family over a longer period of time?
Yeah, look, and I think that's a really good point. It's about wealth creation. We don't go into this looking to make a mistake, but I think sometimes people rush in because, everyone's got an Uncle Jack that they spoke to at a barbecue who's done really well out of a property he bought in '83, but things and times have changed. And you touched on something there, and I'll come to Justin on it first, which was getting your structure right. I think that's something people don't quite understand. And look, I've spoken to clients who have bought properties and then gone, oh, actually, it shouldn't be in my name, it should be in something else. And then there's a mad panic afterwards.
Yeah, absolutely. So if you get your team involved at the start, you can get the structure right at the start, because it's quite costly to change it if you need to make a change later on. So yeah, that's certainly we'd like to be discussing in the lead-in to purchase. You want to be getting your finance approved and that sort of stuff. Also get that structuring discussion happening with your accountant and your financial planner previously to know what's the best place for the property, and it'll depend on what you're buying the property for. If you've got a husband and wife who have different levels of income, one's on a high income and you're getting a negatively geared property, that might lead you to purchasing the property in their name, or vice versa. If you're buying property to build wealth for the family, a trust structure could be appropriate, or joint ownership. There's lots of different combinations that can be used, and yeah, it's definitely good to have those discussions in the lead up, not
after the fact. and Peter, you and I have discussed ad nauseum about SMSFs and the benefits and also some of the prohibitiveness of them, and I think that's something people don't quite get their head around. They always come and go, I'll just buy it in an SMSF, and you go, yeah, but have you got it already set up? And they kind of have that blank look in their face of, oh, I didn't realise that.
Yeah, there's a bit of a dimming view on superannuation funds having single assets within there, whether it's property or otherwise. The ATO aren't particularly friendly to single asset funds, and a lot of the time when people are thinking about buying property within a self-managed super fund, they haven't had those structures set up, which can take anywhere between 6-8 weeks to get the raw structures set up. But the concept for then trying to get debt within that structure or around that structure to be able to facilitate the purpose can be another 12 to longer in terms, 12 weeks or longer in application, and it's not as easy as it seems. There is a lot of issues when it comes to double stamping. If structures aren't created when you're signing contracts, then...
And I think you're right there, but also some of the limitations of what you can do in an SMSF. I mean, we could spend hours going over that, and I think a lot of people just kind of think it's a cookie cutter approach. They've been to a seminar that's told them that they should do this from a spruiker, and really that always makes my hair stand on end, what's left of it. When I start hearing they've gone to a seminar, that worries me no end. And I think when we're building a team, one thing we don't necessarily talk enough about is making sure we're looking all together. We're looking at the right assets, and both the accountant and the financial planner have the same goal about it. Peter?
Yeah, so look, for me it all starts off with that initial concept. What is it that you're trying to achieve? Why? What is the time frame? How can we help you get that with less risk and a better outcome? So it might come first to a concept of how much I can afford out of my cash flow to go towards this asset. That will then help us determine what sort of an asset is the maximum purchase price that you could consider. We then dig deeper and talk and better understand what structures could be appropriate. How do we intend to use that asset going forward? Is it for personal? Is it for investment? Is there another ancillary benefit that we can find from there?
Yeah, no, look, I agree, and you touched on it briefly there, just with the personal, is it going to be your principal place of residence? And I don't sometimes think that people quite understand how much of an advantage the principal place of residence rule we have in Australia is, and what the tax implications of that are, Justin.
Yeah, I mean, if you've got a property that you've lived in as your principal place of residence throughout the period of ownership, then that's going to be free from any capital gains tax when you sell it. And that's a simple example. Quite often people will use that property, live somewhere else for a while, rent it out, move overseas, rent it out, or have people, there's a lot of things you can do to implicate the main residence, which is another issue that's just probably
and
for
I
another
think
episode.
even and with COVID now, the home office mentality, I don't think a lot of people understand what happens when you start claiming your home, if you want to just have a quick touch on that.
Yeah, correct. So occupancy expenses are considered, if you're running your home office as a home office and you're just claiming running expenses, so some electricity, gas, that's fine. That's just representing the fact that you have some expenditure relating to the fact you're working from home in an office. If you're claiming a percentage of your interest on your loan, land council rates, that sort of thing, then that's what's described as occupancy costs, and that's where you do fall a bit foul of the main residence issue there. So if you're running a home office, you're fine, you keep your main residence exemption. It's considered a place of business, and you want to claim those occupancy costs, then that's an issue that will implicate the main residence exemption, which protects you from capital gains on the sale of property.
There's so much detail involved in this, and I think that's where a lot of people kind of get a bit bamboozled by it. And I think that's where, over the long term, you really do have to start thinking about this. I often say that it's, your biggest single purchase is either a home or an investment or something like as a single asset. And if you get it wrong, you can really stuff, for want of a better phrase, stuff up your whole financial position, can't you?
Oh, absolutely. When it comes to property, given how illiquid it can be to get in and out of a property, just because you've decided you want to buy a property doesn't mean the market's got one for you, and just because you want to sell it doesn't mean that the market's willing to buy what you have. So when it comes to property-specific assets, you have to consider liquidity and make sure you've got a longer duration and you've got the ability to hold that to enable you a succinct exit out of that asset to reduce your risk of any losses that may occur over that period.
100%. And look, I think that's something that we talk a lot with our clients is, well, okay, we've got the way in, but what's the exit strategy? And I think that's sort of what we wanted to really talk about today, was just have a think about it, talk to people, make sure you're talking to the right people and you've got a team that can all work together. There's no point in having an accountant who can't deal with your financial planner and vice versa, or neither of them that want to deal with an advisor. So you've got to make sure your team is functioning, but you've also got to make sure it's the right team. Guys, I really appreciate your time today and coming down and being on Property Matters for the Informer. It's been great to have you here.
That's great, thanks.
Thank you, Sam.
Thank you for watching the Informer. This has been Property Matters and building your team. Thank you.